When you're investing in the stock market, it really comes down to two big primary ways of investing, which is fundamental analysis and technical analysis. There's some things you can do with algorithms too, but they kind of tie into the technical analysis. But fundamentals and technical analysis. Fundamentals is kind of what we've already been learning about, understanding the fundamentals of a business and understanding, patterns and things, not patterns, but understanding their ratios and things. And technical analysis is more about if you think seeing things like stock charts or these funny looking candlestick type things and all that stuff. That's what it kind of goes into technical analysis. And we have a whole section on technical analysis that's coming up. But we've really been talking a lot about fundamental analysis, through the course so far. And with both of these, you can use either style, fundamental analysis or technical analysis, or you can be like me to have a little combination of both. I'll use fundamental analysis, for example, and then I might use some technical analysis to kind of maybe reinforce some of my choices. The fundamental analysis also lends itself better to maybe long-term buy and hold investing. Technical might be a little bit more oriented towards short-term trading because you're looking to get in and out maybe quickly on a position. So like a day trader, someone who's constantly trading throughout the day, would be very focused on technical analysis, maybe less so on fundamental analysis. Let's do a quick overview or review of some of the concepts from fundamental analysis, and then we're going to roll right into a whole section on technical analysis around charting, momentum, and all that I think you might find very, very interesting. So if we look at fundamental analysis or fundamental investing, you're looking at the fundamentals, right? Some things that are core to the business. You're really trying to understand the business, and then there's ratios and things that tie into that too from an investing standpoint. So from a fundamental standpoint, you want to understand the business model. You are an owner. When you own stock, you are an owner in that company. So you want to approach it like an owner and understand, what is this company trying to do? What is their business model? How do they differentiate themselves? How do they differentiate themselves from their competitors? How do they appear and approach their customers, and how do their customers see them as being differentiated? What are the features and benefits of their products or services? As a customer, why should I buy your product or service? What's the benefit going to be to me? There's some things in there, some management type things, like is there a first mover advantage? You're the first company to really do something, and you really built up a big lead, or you really took the, really established a dominant position quickly. Is there a first mover advantage? Is there, compared to other companies? Is there barriers to entry or copying from others? Are you really established, and so it's harder for people to copy and replicate what you do? So for example, like Google with its search ability, you have other search engines like Bing and other search engines that are out there, but they don't have the dominant market share that Google does. And so there's a big barrier to entry, not only from a market share standpoint, but a big barrier to entry from a technological standpoint, and building a team to compete with Google. If you and I together decide we want to kind of compete against Google, we may need to find a real small niche to do it, because competing head to head, they have a large barrier to access there to copy them or replicate what they do. And is the company in for the long term too? What does their long-term prospects look like? When you're looking at companies, especially if you're a long-term investor, a long-term maybe buy and hold investor, that you might hold this stock or hold this company stock for a long period of time, then you might want to look at, well, if I'm going to hold it for 5-10 years, how's the company going to do for 5-10 years? Or is this more of a shorter term trading position? So that's kind of like around some of the keys around fundamental analysis from the business standpoint. And then when we talk about things like ratios, like the price to earnings ratio or dividend yield or different types of ratios, that whole section on ratios, that's also part of fundamental analysis. Ratios are part of fundamentals, understanding the fundamentals of the business. How are they doing right now in this current or past performance, in this moment of time? And can we use that to help predict the future? You have to decide whether that's a predictor of future, or maybe it's a good value to buy in, or maybe how it fits your fundamentals of how you want to be an investor. If you're a dividend investor and you want to have income coming in on a regular basis, well, then you want to look at dividend companies, and so you look at those dividend type ratios, dividend growth rate, dividend yield, those types of things that we talked about. So you're really measuring performance in a current type thing. So ratios are not technical analysis. Technical analysis is looking at charts, it's looking at patterns. We're going to get into that, and that's trying to actually predict what's going to happen in the future based on what's happened in the past, from the movement of, let's say, its stock price, for example, and comparing to moving averages and things we're going to look at here in just a moment. But ratios are more looking at fundamentally how solid is the business, how solid has been the performance, and does it fit with maybe your investing model that you're looking to do. Let's take a quick look at an example of a company so you can kind of see what we mean from a fundamental standpoint, so you can start thinking along these ways. And a little bit more of a review of some of the things we talked about earlier too. So if we looked at Amazon, for example, Amazon, a big global international company, most folks know Amazon. Obviously, you go on their website, you can buy all sorts of products and services. That's where Amazon grew out of and was famous for, particularly selling books early on, but now they sell everything. So Amazon, big brand name. What are some of the fundamental advantages they have? Well, certainly a big brand name. That's why I chose them for this lesson versus something obscure, because I have blessed with students from all over the world, so better chance you're going to know Amazon as far as a big brand name. They have a huge first mover advantage. They weren't the first company to offer products and services on the internet, for sure, but they certainly built their model and built their distribution network and built things that to be very successful. And now the first mover advantage, where they became kind of the kings of internet product sales, is really a big advantage. It'd be hard to compete against them one-on-one. You can find little niches to compete against them, but they're the big guys out there for sure. So they have a huge first mover advantage. They dominate the niches that they're in, dominate that online purchasing. And by doing that, they've built in a lot of technological advantages and distribution advantages too. It's one thing to have the technology, it's another thing to actually take an order and then move that order from a distribution center to another part of the country or another part of the world, possibly, to get that product to the customer in a timely manner, in a manner where the product isn't damaged and quick and fast, and have all that branding around it. So they got those types of advantages. So if you think about fundamentals, wow, that's really good. And then you could look at, let's look at some of the ratios and financials, at least at a moment in time around this. But if you look at fundamentally from a business model standpoint, you might say, okay, they're pretty good. They're certainly a big player for sure, as far as some advantages. Now, if we look at some of the ratios and some of their financials, they got a lot of cash on hand. They get tons and tons of cash, which means they can do things with the cash. They can buy things with the cash. Other companies, invest in new products. We'll talk about that in a moment, but they've got a lot of cash on hand, which is really good versus maybe a company that's cash strapped. Now, their price relative to their earnings, right? Their price of their stock relative to their earnings is like 286. It fluctuates, but it's around 286 right now, and it goes up and it goes down, all that. I mean, it's just like massive. It's like almost, how do you even equate that? I mean, if something that high, you'd say it's way overpriced. You'd never buy it, but it's a growth stock, and the idea is this could keep growing and building, and people are willing to pay a high multiple to earnings. You heard about earnings multipliers. They're willing to pay a high price compared to the current earnings because they're buying into that future growth aspect, that dominant growth. Amazon doesn't pay a dividend at this time, so there's no dividend measures, because they're a classic growth stock. They don't want to pay us, you and me, the investors, as a dividend. They want to take that money and invest it in new things into the company to help grow the company and get our return on our investment through capital appreciation, as in the stock price keeps going up and up and up is the idea. So they're a classic growth company. You can look at this from a fundamental standpoint. This is how you'd want to think about companies. You could say, maybe you'd look and say, I understand the business model, I think they're doing great, maybe I want to invest in them from that standpoint. But then another investor might say, yeah, but and it's nice they got a lot of cash, but I'm really worried about the price I'm paying from a stock price. Maybe there's better choices, better value out there for me. And maybe I want to invest in something that gives me a dividend too, so I might pass on Amazon. So that's why investors look at all these investments different ways. Remember, to have a stock trade, you got to have somebody who wants to sell and somebody who wants to buy. And people are buying and selling, they have different perspectives on how the future prospects of the company would be. So could we predict the future of Amazon? No, we can't predict the future of them, but we can have a feeling about that, and the questions we want to ask in ourselves as investors in this example. And really the key example for this with a growth company is, can they keep growing? Can they keep growing at the rate they are growing? And then you could look deeper into the numbers and say, what are they going to do with all that cash? Might they pay a dividend in the future, which might help their stock price too? Will they pay a dividend in the future? Will they buy back stock, which also helps raise existing owners of stock, raises the prices up? So stock buybacks are good. Maybe they'll buy some stock. Maybe they'll acquire companies. Acquire companies, like there was an acquisition of Whole Foods, more United States based, but Whole Foods was an organic store selling food, grocery store selling food. An interesting play by Amazon to buy Whole Foods. But they got that cash, they can use that, to help buy on other ways, to finance, of course, buy companies like Whole Foods and expand their reach. Or expanding their reach through new product offerings. Research and development would be typical in companies. What are some new products or new offerings they could do? So we'd think about that. Can they use that cash? Can they use those investments to keep investing in the company? Through things like new product offerings and extensions. Here's just a list of a few things that Amazon has done, from going from basically somebody sold books essentially to more goods and services to things like Amazon Prime, Kindle e-readers and all that. Streaming services now, growth area streaming services of video and music, getting involved with video and music, and certainly they sell devices now with Echo and Alexa. Here's a picture of Echo, devices that they sell themselves in addition to all the other products they sell. And then you have Amazon Web Services, where they provide services, web support and web services to other companies. So they really kind of branched out that way too by using their expertise in that technology and web design and web services and transactional services, and using that to make another revenue stream for them as well. So there's an example where fundamentally you're looking at this company from a fundamental standpoint. In the next lessons, we're going to start talking about a technical analysis where you're really not even looking at the fundamentals, you're looking technically to see how is the stock price moving and how is that compared to where it's been. And the idea is you're trying to look at an opportunity to buy in and then sell. So next lessons are going to be about technical analysis, and it's going to be different than some of the fundamental analysis that we've been doing. Oh, and last point here too, by the way, you can use, as I said before, fundamental or technical analysis, or you could concentrate 100% and just be a fundamental investor and you'll do perfectly fine, or you could be a 100% technical investor and you could do fine as well too. You don't have, one is not necessarily better than another, it's more about what fits you and what you like to do and how you want to approach it. But they're both two schools of thought that have both been successful over time. Let's talk about technical analysis now, the other camp of investing. If you think about fundamentals, we were talking about the business model and what's the future look like and how are things kind of organized around that. Technical analysis is really looking at more specific patterns and charts and things, and let's dive into this other type of camp. It's okay to use them together, by the way, though they are really two distinct camps. I think it's fine to use them both together, but more on that in a moment. Let's talk about technical analysis and what it is. So technical analysis, also known as, you may have heard it called as charting, because technical analysis, you're using a lot of charts to evaluate things. You're kind of using different ways of looking at these patterns and repeatable patterns using these charts. It's used in stock investing. It's used in certainly in stock market investing. So it could be used in cryptocurrency or Bitcoin type investing, and really in type of thing where you're measuring price and you're measuring performance. And what you're doing is you're looking for repeatable patterns. You're looking for repeatable patterns, and you're looking to see if this pattern happens, like it's rising or it's falling or whatever, and then I can predict, just hopefully with some accuracy, what's going to happen next based on the pattern and some well-established patterns. It doesn't always work out that way. In fact, that's the thing with technical analysis. It's never 100%. Nothing is 100%, but the idea is that these technical patterns have happened over and over again, and we can learn from them and maybe take action based on them, is the idea of technical analysis. If you're talking to somebody who's a true technical analysis person, one thing they'll say is, hey, these fundamentals don't matter. That whole business about understanding the business and all that and what they're trying to do and supply and demand and all that stuff, forget it. Forget it. Nothing matters but the chart. It's just the chart that matters. And especially like somebody's, let's say, a day trader, where you're frequently trading throughout the day or whatever, you're not looking at long-term growth or anything like that. You're looking at individual small moves up and down, and you're trading in that and trying to make those money on the margins of that and making margins on those frequent trades for a day trader. But anybody can use technical analysis even for long-term holding, and I think fundamentals do matter, but they both can be used together. So technical analysis is really all about the herd mentality. First, to understand the basis of what's going on here, is understanding a herd mentality. Here's a definition of herds, of the definition of herd. You can see some sheep here. And the definition is a number of animals kept, feeding, or key part here, traveling together. A herd of cattle, a herd of sheep. And I think the idea that I highlighted here was this herd is traveling together. Think about like the market, and the market is made up of individuals and institutions are made up of individuals, you and I, who are making investments. Some investing more than others, but either way it's individuals. And we're traveling together along this market. We're in this market, we're in this herd, and we're traveling together. Another definition for herd is common people, the masses, the rabble. Well, that doesn't sound so nice. He had no opinions of his own, but simply followed the herd. And that's the idea behind technical analysis is, sure, there's individual people or individual opinions, but really you're following the herd. And if you can figure out where the herd's going to go next, well, then you can make an investment decision behind it. So yeah, a lot of icky definition, right? We're human beings. We're not part of a herd. We're not sheep. But the idea is that markets and things will tend to move in certain directions. I mean, let's look at the sheep picture a little bit closer to get an understanding of how markets move, actually. And you might have heard the term momentum investing, right? It's like Einstein's theory of relativity, or the theory of motion. Things that are in motion tend to stay in motion. I might have got the relativity wrong. But the idea you might have heard, from grade school science is things that are in motion tend to stay in motion. You roll a hot rock down a hill, the rock will tend to roll down to the bottom of the hill. It won't just automatically stop. It's in motion, it tends to stay in motion. Markets that are in motion, in stock or cryptocurrency, any type of markets that are in motion, will tend to continue in that direction of that motion. Like these sheep here. The sheep are looks like on a road here, and the sheep are in a herd, and they're all traveling together, and they're going down the hill, looks like down this road. And you can see that the sheep are traveling as a herd. So if I was a technical analysis person, I might look at this and say, I bet the sheep are going to keep going down that road. I mean, just look at all those sheep. It looks like they're probably going down that road. How I would look at that investment is I'm looking at a chart, and we're going to look at some sample charts and how to analyze them in a moment here in the next couple lessons. But I'm looking at my chart and I'm basically substituting prices of, let's say, a stock or cryptocurrency or whatever, and I'm following that sheep down the road. So that's the idea of the herd mentality. Last thing too with this sheep picture, as you look at the sheep picture, do you see anything that's different? I mean, you see some sheep headed down the road. You might see the hill with some scruffy dirt or whatever on it. That doesn't look too appealing. But do you see some sheep that might not be following the herd? If you look closely, you probably do on the left, where there's looks like some nice green grass. If I was a sheep, I suppose I'd want to go and hang out in that grass. And as you can see, there are some sheep that are going over there. So when markets move, they don't move exactly 1% together. You got people who are buying and selling all the time. And you got some people, sheep, I guess, going to the hill. Maybe going in a different direction is the key, a different direction. And in technical analysis, we would call that a breakout, right? You might be trading in a certain pattern, stocks going up, and all of a sudden, boom, it goes way down. Or you're trading and all of a sudden it goes way up, right? Things go way up or way down. Or the pattern changes. That's a breakout. So in the sheep picture here, if we were looking at this as a chart, we'd say, is there enough sheep on the hill to convince the other sheep on the hill or a sheep on the road, hey, you should join us on the hill, and is that a breakout, and is that a change? All right, so enough about sheep. Now let's look at some charts and do some actual understanding of the charts and technical analysis and how this can work for us. For example, a lot of charts are set up like this, a real basic chart where on the left-hand side, on the horizontal, on the vertical axis on the left-hand side, you'd have price, right? Price going up and down. And then on the horizontal, you'd have time, time periods, day 1, day 2, day 3, month 30, month 60, 2 years, 3 years, 4 years. It's time going this way. Pricing changes up here. So as you can see on this sample chart, you doesn't even have to worry about the exact numbers, but just to get an idea of the chart, you can see highlighted here 1M. This is a 1-month chart. And you can see that the prices on this have risen over time up to that first little bar at the top I have there. And then they started falling over that next period of time to where that next bottom line was, at the top and the bottom. There's actually support and resistance. We're going to get into that and why those are important. And then it goes back up. So you can see over time how the prices fluctuate. You've probably seen this before. And the idea of charting and technical analysis is understanding the chart and what it might tell you next. If we were one last thing on this particular chart before we get into some more detail in the next lessons, you see where the red circles are, and you can see the starting and end point in this 1-month time frame are about the same. The prices went up, and then they went down, and then they came back. You can see they're about the same. They're trading in that trading range. So, but they don't have to. They could go way up or they could go way down. So this is a sample chart. Now let's really get into this in more detail and really understanding charts and technical analysis in the next lessons. Okay, so we understand with technical analysis, there's going to be some analysis involved, some charts involved. And the real key here is understanding some big concepts here is that repeatable behaviors will continue to repeat themselves under repeatable circumstances, right? So we show the picture of the sheep moving down the hill. That was momentum. That was some established. But the idea is if we could see, like if we were in another road and there were cows on the road and the road looked the same, that the cows might follow the same pattern, that's some predictability behind it then. There's no guesswork there. We're like, sheep did this, the cows will probably do this, same kind of road. There's a predictable behavior here at that point in time, those repeatable behaviors under repeatable circumstances. And you're looking for predictability. So it's not guesswork. This ain't just guessing or like, oh, that looks like a nice looking chart, let's just guess. and see which way it's going to happen. And there's a strategy behind this. Technical analysis is a strategy, like fundamental analysis and fundamental investing is a strategy. Technical analysis is a strategy behind it. It's not guesswork. There is a strategy behind it. And one of the overall key concepts you want to take away from this whole section on technical analysis is the trend is your friend. You read anything in technical analysis, you'll probably see that quote, the trend is your friend. And why is the trend your friend? Because you want to get on that trend in the way that you want to head. Let's say if prices are rising, you want to ride that wave. You want to ride that trend, and when it changes, then you want to get off the trend. So you can see technical analysis is can be much more frequent trading than maybe fundamentals or things that might be a long-term buy and hold strategy. Technical analysis might be more advantageous for that trader, somebody who wants to get in and out, for example. So the trend is your friend, and you want to identify trend after it breaks out one way or another. And you want to get in and out based around that trading around that trend. So it's not so much about trying to predict is the trend happening or what will happen with the trend. You want to see where it's going, let the trend happen, and then get in. Because if a trend doesn't happen, it's not really a trend yet. It's still, maybe it's a guesswork at that point. It might go off the direction you want, or it might not go the direction you want. So the trend is your friend, but you need to let the trend establish itself. That's a real key part of technical analysis. It might be seductive to try to get in early or too early, but you might not be in a trend at that point. You might be just kind of guessing at that point. So technical analysis is about identifying trends, let trends happen, then get in, and then get out when it's time to. A couple other key concepts with technical analysis is not 100% accurate. Oh my gosh, if it was, you wouldn't even have fundamentals, for one, because technical analysis would say, we don't even care about fundamentals, just do the charts, just look at the technical part, just look at the patterns. So if it was 100% accurate, no fundamentals, you really wouldn't even have investing courses. Everybody would just do the same thing because look at the chart. If it looks like this, you buy, boom, you're done. But it is an idea of being predictors. There is a strategy behind this. There's some proven success factors around it. It is predictors. Think about like the weather, for example. If you have weather forecasters or meteorologists, they're not right all the time. In fact, many times they're wrong. But they're looking at models, they're looking at predictions to see what the weather will be like, maybe the next day or the week. Is it 100% accurate? Absolutely not. But you're more likely the person is going to say to you, the weather forecaster, it's not going to be raining tomorrow, it's going to be sunny. It might be partly cloudy, but it's probably not going to all of a sudden have a thunderstorm develop. Hopefully. But once again, it's not 100% accurate. The thunderstorm could develop. So it does not work all the time. No technique works all the time. And no technique works on every single type of currency, stock, whatever it might be. No technique necessarily works all the time. And you also have unpredictable events too that can happen. Things that be like, I have this pattern and everything's kind of coming good. It looks like I've had a trend breakout, and then some unpredictable event happens, that an outlier that you can't predict, that all of a sudden just messes everything up. And that happens at times, and to be okay with that, understand there are things beyond the market, beyond the trend, things are happening beyond what we're looking at. So now we're going to really dive in deep and really look in close at how we can evaluate charts and look at patterns and make some choices and some investments using technical analysis. So if we think about the unpredictability of what can happen in the stock market, and even if you do all this wonderful charting and all this technical analysis, things can happen. Unpredictable events can happen. Here's a headline from one that's a few years back that's kind of interesting. As far as no matter how good your technical analysis was, it really kind of all went out the window, at least in certain stocks, around this particular event. And this event we're talking about is Brexit, right? England leaving the European Union and the vote around that. This is an article, a headline from 2016 when this happened in June. And here's the headline: "This is Brexit. London and European stocks get crushed." Right? I mean, think about that. That's was unpredictable type event. They was supposed to not go that way. The Brexit vote wasn't supposed to go the way it did. They were supposed to vote to stay, and it was a surprise type thing. So what happened was the stocks did get crushed. The top 100 stocks, the FTSE 100, went down 3%. Not too bad actually, at least on that first day. It was down at like 9% at a time for across the board, but still down 3.2. But other things started happening too. The pound dropped to the lowest level in 30 years against the U.S. dollar. And other markets were affected too. Germany, France, Ireland, all their markets were down 7-8% each just on this one vote here. So this was something you couldn't predict from a technical standpoint. Everything might have been fine, particularly as we look at individual stock, and then all of a sudden, boom, this happens, and everybody gets caught up, and it's like all boats on a sea, and when the tide goes out, they all go down. Well, this is what happened. They all went down because of Brexit around that. Just like a rising tide will raise all boats or raise all stocks too. And good news, this was something where the markets reacted unfavorably to this news, because markets don't like unpredictability. That's for sure. We know that. So when something this big is unpredictable and it happened and wasn't supposed to, at least according to the experts, remember the experts, then that's what happens with stocks. And particularly like banking stocks were the biggest losers around this because of the global economy and how things are tied from a banking and financial standpoint. And if you look at some of these, banks here on that particular day, this is one day, Lloyds Bank was down 21%, Royal Bank of Scotland down 18%, Barclays down 18%. And then it really spread further out, especially into the European Union. Deutsche Bank was down 14%, and they're not even part of England, but they're just so tied into the global financial market. So all markets were really affected. And then later, when the Asian markets opened up, their banking stocks in particular got crushed as well. So no amount of technical analysis could have really helped you with that unpredictable event. But just understand those things happen, and then kind of move beyond that and move forward with it. And understand that was not out in your control. It's how do you react to that is the key part of that. So technical analysis can be really, really helpful in many, many ways, but it's not 100% foolproof is the thing to take away from this, particularly when you have big unpredictable events like Brexit. I'd like to share with you a personal story here about how I learned about Brexit and some interesting facts, interesting information around that. You can skip by this too. It's just kind of an investing story or investing thing that really happened. And my hope on this at the end of it, you'll see a philosophy or perspective that might help you. It certainly has helped me of having this type of perspective. So Brexit, right? Brexit happened, unexpected. All the banking stocks go down 20% or so, and it was kind of a tough day for the markets, to say the least. So how I found about it, and that the vote went a way that wasn't expected, the vote to leave England, to leave Britain, to leave the European Union, was I was actually traveling at the time, traveling for fun, for pleasure, actually on my own, and I was flying from. I was traveling in Scandinavia, and I was flying from Bergen in Norway to Stockholm in Sweden. Just great places to visit. I was up in Bergen, went through they have a fjord tour that goes from Oslo to Bergen, where you spend a whole day going through fjords, and you're on trains and on water and all that. There's my travel log there for you, and you're going through the fjords, just beautiful, so wonderful. And then it flew directly from the next day from Bergen to Stockholm. In my flight is where I learned about Brexit. An interesting thing, and this is where it's interesting from a global perspective, how I learned about it was from actually a tourist or a person traveling from Japan. A little woman, a little older than me, and we were sitting next to each other, and it was kind of funny. She had learned English actually from somebody who lived nearby me. I didn't know him, but lived in the city I was at or nearby. So we talked about that. But then she started talking to me about Brexit, and had I heard about the Brexit vote and what was happening, and me, I know a little bit about investing, so I was sharing some information with her, and we were talking about that. And so that's how I learned about Brexit while I'm flying from Bergen to Stockholm, and we had a nice conversation about Brexit, what that would mean and what that might mean long term. We were in agreement that short term would be very volatile, probably pretty nasty for many stocks, but long term, things even out, things get better long term. That's been the history of the stock market, no matter which markets they are, over long periods of time. But it's certainly short term pain. The last part of the story I want to leave with you is not only was I not missing my flight or constantly saying, has anybody heard about Brexit? Anybody heard about Brexit? And all freaked out before I got on the plane. It was like, oh yeah, Brexit's happening. And oh, by the way, they voted the way that wasn't expected. And then I found about that on the plane. So many folks would then exit the plane. What would they do first? They would try to get on a computer somewhere at an internet cafe or rush to their hotel, check their investments, and just get all freaked out about it and see some of their investments going down and really have a lot of turmoil. And there's nothing wrong with that, by the way. It's your money. You've earned that money through hard work, and that's okay. I just wanted to just share with you, it's okay to be relaxed a little bit about it too. It's important to have a diverse portfolio. If I had all my investments in banking stocks, particularly in English banking stocks like Barclays and Royal Bank of Scotland, boy, I would be having a panic attack, well, for sure. But as a diversified investor, and all that, it was less about that, more of a curiosity, and actually more looking about maybe there might be opportunities to buy. So, but I didn't rush the hotel and all that because I'm on holiday, I'm on vacation, And I'm here now in Stockholm. Yeah, I might have checked a couple of things, watching a little bit of the news or talking to people about it for more of an interesting way. So I could either lock myself in my hotel room and just watch the stock ticker, or I could understand that I have a long-term plan, that this is ups and downs are part of the plan. And I could continue my holiday, which involved, if you've been to Stockholm, going to the old town or old part of Stockholm, which is absolutely beautiful. I'm sure there's people from Sweden, from Stockholm saying, you tourists, you go into the old part, everybody goes there or whatever. I'm just telling you, here's an image of it. Where would you rather be? In your hotel room looking at stock symbols, or would you rather be here when you're out on holiday? I tell you, it was very calming and very, very effective thing. So if you listen to this lesson through here, thank you for indulging me, and hopefully you took from there the message of, once again, things that we've been talking about of diverse portfolios, international, domestic, all the different things, and that understand that money is in investing is really to help support your life, which is the joyous parts of life. And this is the joy that I have. And I remember that day and I remember that trip, and it was just so wonderful. And that trip through Scandinavia, where I was in Copenhagen, Oslo, Bergen, and Stockholm, just beautiful, wonderful, for many a trip of a lifetime. And so understand that stocks and investing helps feed that and not the other way around. And look at this picture and think, boy, this is maybe where you'd want to go, and I hope you get there because it's wonderful. We're going to look at some of the most common and key type of charts and techniques to use. There are 1,000 different techniques out there. Oh my gosh, there's so many ways you can overanalyze stuff. We're going to look at the most common things that you'll see over and over, and things that you can easily start with and start using yourself. At the end of this, my hope is that you'll be really comfortable and start using technical analysis. So first off, the line chart. Oh my gosh, you see that all the time. It's hard to avoid. And because it works, and it really gives you a really quick and easy understanding of what's going on. Show your closing price over a specified time period, and it may show volume. Volume being how much trades are happening. Is it a high volume day or a low volume day? So it's going to show all that on one chart. Let's take a closer look at that here. So here's a typical line type chart. I'm taken from GDAX. There's real live stuff you can look at. This is, you can see on the upper left where it says price chart. I've chosen a line chart. I've chosen over a 30D or 30-day period. You can choose the length of these charts. It could be for 4-hour charts, real short time periods, to 30 days or longer type of periods. But this happens to be a 30-day period when we're looking at this chart. A couple of things when you're looking at a chart to just kind of explain and be clear on so you get a good feel for it. One is the price is the vertical axis, as we talk about. Price is the vertical axis. Time is on the horizontal axis. So if you start on the far left, time over those 30 days is, day one would be closest to where they intersect the price and time chart, and 30 days out would be to the far right along the horizontal or bottom or time axis. Price fluctuates over that period of time, so you can see in the graph where you have all these peaks and valleys, that's where the pricing is fluctuating over time. I've highlighted with a red circle the top or peak in this particular chart and the bottom or the very bottom of this chart in terms of price, and you can see there's pretty wide fluctuation between the peak and the bottom. I don't happen to have the actual numbers on the side. You normally would have that. I just don't have it. You don't need it for the demonstration purposes, but you can see the difference, that there is a difference between the high and the low price. So this is a typical type of chart. Also, you might see a lot of overlaid on top of a line chart, a pricing line chart, is volume. This you see all the time. You may not, but you usually will. And the volume is the bottom part there where you have these bars that go up and down. In this case, like a green bar would represent an up day, it went up for that day, and red would be the end result, the price went down for that day. You can kind of see where the green lines sort of match up with where it's going up for the prices and red goes down. It might be harder to see as you get in some of the closer together squiggly lines, but you can see that some days are up and some days are down. And then the height of the line, of those volume lines, shows you an indication of how much volume there was graphically. So if we look at this chart, you can see everything's kind of pretty smooth, everything's going along until we get to the far, not all the way to the right, but the far right where it really went down in price, that bottom red circle. And you can see all these red lines where there's a lot of volume, a lot of people trading, and then green, a lot of people trading to go drive it back up, the price of it. So in that trough area, there was a big drop and a big rise in pricing is what's happening there. Another thing you can do with your chart is you can start seeing some trends, and we're going to draw trend lines in another lesson, but if you look here, I'm going to draw just a little line here on this next one, and you can see when I'm at my peak there, if drawing the lines connecting two other peaks, you can say I've connected to two other peaks, you can see the line kind of downward sloping. Well, that shows me that there's a downward trend going on. Obviously, when we get to the end of that downward trend, it's kind of like falling off a cliff because you can see dramatically that it went down. But before that fall off the cliff, you could see that even though there was some rise, it went down and there were some rises off that peak, the overall trend was down. And remember, the trend is our friend, and we're going to learn about drawing trend lines and looking at trend lines here in another lesson. If we look at the same chart, but I pulled out a 6-day period here, you can see where it's a line chart, it says 6H, oh excuse me, not 6 day, 6 hour period, a 6 hour period. You can see within a 6 hour period much more volatility, right? Because prices are constantly changing here. And I have a couple, valleys there and one peak there too, and a couple other peaks actually. But notice how, what I want you to notice from this one is notice how that the volume at the bottom, when something dramatic is happening, volume will tend to go up. When prices are falling fast or when prices are rising fast, volume will tend to go with it because people want to get in the market or they want to get out of the market fast. A lot of active traders are like that. Might be some fear or panic selling, or maybe some fear and panic buying, like they don't want to miss out on there too. So you can see how the volume will tend to match up, not always, but will tend to match up with price declines and price rises. So that's your price chart. Once again, pretty straightforward and something you want to get real comfortable with. Price on the vertical, the time period, like this is 6 hours, would be hour 1 would be just starting towards the left, and hour 6 would be to the far right. You can sometimes see volume on the bottom, and you're looking for how are prices changing over time, and we're going to look in a little more detail on that in the upcoming lessons. Well, you see these price and line charts all the time, but the other chart you see a lot of that you want to be comfortable with are candlestick charts, and really understanding those. And we're going to take some time to really understand candlestick charts because they give you a lot more information and can give you a little bit more insight into things too, beyond just the basic price and line chart. So using them in conjunction with a candlestick chart can be very, very effective. They're very, very common, and they're actually very easy to use once you understand them. They may look a little confusing at first because there's little tricks to them a little bit, but once you understand them, it'll make some sense to you. And the idea of why they're called candlestick charts, by the way, is they look like a candlestick, a wide body or rectangular body, and then you have a wick going up, and they actually, like burning the candle at both ends, if you're working hard, is an old expression. They actually have a wick going out the bottom too. And they look like a candlestick. So let's take a look at those. All right, I have two candlesticks here. One is green and one is red, and the actual color represents something too as well. So first off, if you see a candlestick that's green, or it might be showing up as white, depending on the exchange or what you're looking at, but if it's green or white, that means that the closing price is higher than the opening. So if you see the rectangle where it's green in there, and you can see at the bottom where it says open, and then at the top is close, that means that open price was at, let's say, X dollars or whatever fiat currency. Opening price ended up closing higher. Think of it like it started at the bottom of the rectangle and finished at the top of the rectangle. And the reason it's color-coded is so you can easily at a glance see a bunch of candlesticks laid out all across maybe a chart, which we'll show an example in a second on that, so you can easily see our prices rising or falling. But green or white would say that the closing price at the end of the day is higher than the opening. The inverse of that is the red chart, or sometimes might show black depending on the exchange, where the closing price is lower than the opening price. So you can see here at the bottom is the closing price, and at the top is the opening price at the on this red chart. So it opened at the top of the rectangle and closed at the bottom. Once again, if we have pricing here, you can think of pricing on this on the side here on that vertical axis. Higher price would be higher, lower price would be lower, obviously. So in this case, if it's decreasing, it started open at the higher and then finished lower. All right, so that's the rectangle, the top and bottoms of the rectangle, and the color of what the price is doing when it opens for the day in the market and when it closes for the day or whatever time period of the market, because you could be looking at let's say a 1 hour interval and it would show it just for that 1 hour. Either way, it's an opening and closing. And the pricing depends on the color in the top or the bottom of the box. Now, the long lines at the top and the bottom are the range of pricing that's happening in that time period. So if the price is at the top is the high, and at the bottom of the range is the low. So if we were to look at, let's say, the green one again, by the way, bullish, where it says bullish means is just bulls and bears. Bull means it's rising, bear means it's falling. But when you look at the colors, you can tell you that too. And that's what you'll see. So if we look at, let's say, the green one as an example, we can see that it opened at the bottom of the rectangle. It closed at the top of that rectangle was what its opening price and closing price was. But throughout that time period, and actually people were buying it higher than that close at the top of the wick, at the top line, and people were also buying and selling lower than the opening too in the whole trading range. So the range would be from one end of the wick to the other, and the opening and the close is the body of the candlestick. Okay? It can seem a little confusing at first, but just kind of, you can always review this part again to kind of get it. Now let's take a look at a bunch of them over a time period, because that's what you want to do with your candlesticks, is see how things are changing over time. And the time period could be whatever you want to set it to be. Here's an example of a 7-day time period. This real life example I pulled out. So each candlestick represents a day over these 7 days. If I was to do a 24-hour time period and maybe each one was an hour, I would have 24 different candles, 24 hours in a day. But this example, we're doing a 7-day period, and each candlestick represents 1 day of trading. So what do you see out here? So are you starting to see any kind of patterns develop? Are you starting to see any certain colors or things coming on? Let's take a look at day one. What do you see for day one? I mean, you should see it's red, so it's red in color, so that would tell you that the price closed lower than it opened. Remember, red would be closing with a lower close, and green would be with a higher close from its opening. So it opened at the top of that red rectangle on day one and closed at the bottom of the rectangle. So we know it was a down day for that particular, let's say, currency, that cryptocurrency. Now, if we look at the wick on that day one, you can see at the top a very short wick, so it didn't have much upward mobility. It didn't have much higher prices than what it opened at. And if anything, it went down much further below from what it closed at. So on this day, you could say it was very much a selling day. It was a sell-off type day. So that's day one. So now let's look at day two. You can see day two, it opened at, it's a green, so it closed better than it opened. You can look at the bottom of the rectangle. You can see how it very much matches up with the bottom of the first day, the red rectangle. They opened at around the same price that it closed at. It doesn't always have to be that way, but that's how it may turn out typically. And you can see it was green and went up a little bit, and it closed up higher. And the wick was much longer on both the top and the bottom. But you see also that it wasn't as wide a range of, like the red one, as far as a wider range of trading within the day from the opening to the close. So that would be like a narrower trading range within the actual opening and close times. Day three, another big down day. Very little top wick at the top, closed way down, and even went down further from that. Day 4 and 5 and 6, you can see we're back to more green days. Day 6 is interesting, where it's very, very, very narrow from the opening close, not much change at all, though there was a wider range. And day 7, another down day. So you can kind of see there was a pattern here. We had kind of a downward trend, then a little upward trend, then kind of stabling off there, and then down again, or down, then up, then down. Now that might not tell you anything at this point, but you can see how the pattern works and really want you to understand the candlestick. To further kind of put this onto another chart and overlay this a little bit more information, let's look at this now over a 30-day period. So I took my 7-day period, you can see in the blue box there where I highlighted my 7-day period that we were just looking at, and now put into a wider 30-day type of sample. Now what do you see out there? Take a look at the overall 30-day period. How are prices changing? What's happening from the left at the beginning of time to the right to the end of time? Day 1 to day 30. These are individual day periods. There's 30-day periods. And if you were to look at that, what are you seeing? What types of, are you starting to see some patterns emerging? You're starting to see some things that might stand out to you beyond that 7-day period? Well, you might be seeing, let's talk about a couple of things you might see. One, if you look to the left of our initial 7-day period, you see all the green there. There's a little red in a couple days, but overall, the overall trend was green, where it was an upward rising trend there. So there's a lot of up days, a lot of days where the opening or where the closing was higher than the opening. Then we had our little 7-day period where it was kind of sketchy, up and down, but a little bit of a downward trend. And then after our 7-day trend, we definitely are on a downward trend and have some really big down days. And then we have at the bottom, the real trough at the bottom of those big red and big green candlesticks, to the right there, we start to come back up, and we get kind of up and down a little bit after that. You might also see where the volume spikes there on those big red and big green days. There's a lot of trading going on because the pricing is really dropping and the price is really rising in that particular day. And you can tell that by the length of the body of the candle itself, but also the lengths of its wicks too. If it's got long wicks and long bodies and a lot of trading over that, means there's a lot of action happening in that period. So the more you can start seeing these charts and patterns, we'll look at some details here in a bit in the next lessons, but you can start seeing where now you've got a story kind of being told, right? A fundamental analysis would be like, tell me the story about your business, how you're going to succeed, how are you making a difference in the market, how are you serving your customers. Charting and technical analysis is show me a pattern, show me a chart, and tell me a story so I can make a decision based on that story, whether to buy or sell. So getting comfortable with pricing line charts and candlestick charts are real important, because we're going to start seeing those when we start evaluating the patterns, and you're going to start seeing some techniques like head and shoulders technique, or the cup technique, different triangle techniques, different things that you can now look at these patterns and start seeing, now I can make a decision based on this pattern. Okay, we've looked at some of the core charts, pricing charts, which might have volume with it, candlesticks, and the depth chart. And now let's start putting this together, particularly how we can start looking at trends and how we can start making decisions on that. And remember, the trend is your friend, right? We want to identify trends, let trends happen, and then ride those trends. So the first thing that you want to do, or that's very common to do, is drawing trend lines and trend channels. And the idea is you're looking to see with these lines and things so you can get a visual representation of where the trend might be, so you can help identify trends, and might help identify then later, as we look at triangles and rectangles and things, patterns of these lines that can indicate things that help us with decision making. So when we're drawing trend lines, we're looking at a basic line pricing chart. We're going to look at it in a second here. And you want to pick a point to start at, and you want to draw these, connecting these lines to draw downtrends and uptrends, right? So a downtrend, you're basically connecting all the highs and seeing if the trend's going down. In an uptrend, you're connecting the lows and seeing if you're trending up by looking at these trends. And don't worry when you're drawing these lines, or you're looking at that, they're not exact or perfect. It's not a perfect world, so your lines are not going to be necessarily exact. You're looking for an overall trend, not just super perfect lines to be super perfect. You're really looking for the trend. And sometimes you might be in a little bit more of a sideways market anyways. There might not be a very established trend as it is. So, but that'll tell you that by when you draw your trend lines. Okay, so let's draw some trend lines so you can really get an idea of this when we're looking at these charts and see where the trend is and see if we can find some friendly trends. Okay, so here's a standard type of candlestick pricing chart, pricing line chart with candlestick. You got the volume, bars along the bottom there, price on the vertical axis, time along the horizontal, time going left to right, of course. And if we look at this chart now and we start putting trend lines on it, where we can start seeing some patterns. At least early on, initial patterns start to emerge, some basic type patterns. So you can see I've connected the lows here on the left-hand side. You can start seeing where there's a definite kind to show that as well, versus let's say if this was just a simple pricing line chart, the candlesticks actually show me a little bit more too. And then as we get to the peak there, you can see there's where we're connecting the tops of the candlesticks, and now we're starting to see a downward trend after we get through about a quarter of the way through. You can see in this example, this 30-day period example, each candlestick representing a day, that okay, there's some definite trends going on here, and we can start identifying these trends. Now, when you're doing this, it's pretty simple to draw the lines. It doesn't have to be exact and all that. And this might give you some information, and when we start looking at triangles and other things, we're going to look at this in some other ways too. But when you're drawing this, you want to step back and look at the time periods and say, is this really kind of making sense as far as this overall trends? So for example, as we see like where our volume is spiking to the further right, 3/4 way through where we have those volume spikes, is that part of a downward trend or overall downward trend, or is there really kind of an upward trend that might be starting to emerge? These are the questions that you'll start asking yourself. So if I drew my lines to look more like this, we could see that yes, on the left-hand side, I definitely have my same upward trend, but now on my right-hand side, I have this really steeper downward trend, and then I have this upward trend that might be starting to emerge. Is it emerging or is it not? That is a question. Or is it more part of an overall downward trend like we saw before? So those are some of the questions you'll ask yourself, and maybe layering on some other things to really understand this when we start looking at some other types of ways of interpreting charts. But in the beginning of just getting started, how you draw these trend lines and how you interpret these trend lines will be very, very important. Is it an overall trend down, or are we starting to see a turnaround here as we start looking at that later? Another thing that's important is what's called channels, and they can give you a lot of information too and help with that. So we have these trend line channels, and as you can see here, I basically connect the tops and bottoms over these overall trends. And you can see that there's now forms a channel between the two bars. And on the left-hand side in this example, you can see we have a narrow channel, right? Everything's kind of pretty close as far as the price. It's an upward trend, but it's not a big wide swings in there compared to, let's say, the other two channels that we're looking at in this example, where the top and the bottom of prices are wider between the two, a wider trading range of channels. And you can see on that far right where we were not so sure about, you can see where it connects at the bottom here with those high volume days. Now it's a really wider channel and looks like it might even be spreading out even more. That might lead us to believe that I'm not so sure about that channel because it's so wide that it might continue to be in a downward type trend versus a narrow channel that might tend to stay on that narrower path or narrower road. Let's look at it a different way. Remember we have that overall pattern again? Now we've got that wide channel, but we've taken out that far right part. And here we would definitely say to ourselves, yes, we're definitely seeing an overall downward trend from that peak. So drawing your trend lines will help you to identify what might be happening. Are we an upward trend or a downward trend is not the only thing you want to look at, but it's a starting point and a key starting point when you're analyzing these charts. And because remember, the trend is our friend. In addition to our trend lines, what might also help us is moving averages. And so we can kind of feel for where the average pricing over a period of time is moving, or what direction is it moving, and how does it relate to maybe our trends and our trend lines. So let's look at moving averages here real quick. So here is our chart of that we were looking at before to keep consistent with the price and time. And this is a simple moving average that we're looking at here. You can see the line that's being drawn through here. We've got our candlesticks. You can see there's this line that goes through. That is a SMA, or simple moving average. And really how that's figured out is you add the closing price for a number of time periods and then dividing that total by the number of time periods. You're looking at price times time periods divided by the time periods to get you an average, right? That's what would be your average. And this is a simple moving average where it's looking back over, in this case, the 30 time periods in a simple type of calculation. There's also what are called weighted moving averages, and that's where you're assigning more weight, and really you're assigning more weight to the more recent data. So let's say maybe I assign more weight in my calculation to the last, in this 30-day example, maybe the last 15 days carry more weight than the first 15 days because it's more recent, and thus I might say, that's more important than maybe a simple moving average where it's looking over the entire period. So they both work, and sometimes it's good to use both in conjunction. The exchanges and charts and things, systems that are out there will do this automatically for you. You don't have to do the calculations, but if you want, it's a simple formula to do the calculation. And you can see how the moving average is kind of making its way through our chart here. And let's look at this a little closer here on how to interpret this and how we might make decisions on, let's say, a simple moving average. So when we look at the line, prices that are above the line are showing strength, right? Rising prices. Prices that are below the line are weakness. Prices are falling. So our investment is either rising or falling. So above the line is strength, below the line is weakness. Where it's crossing over the line is what's called crossover points, right? Imagine that. What a great term. Crossover point, because it crosses the line. Well, because that's what's happening. Something is happening. Change is in the air. Change is happening. Potentially changes in the air when it gets to the crossover points. So if we look at this, let's start with the left and work our way through and see if we can describe what is happening in this 30-day market cycle here that we're looking at. If we look at our trending line up, right, we're looking where it was trending up, and then we have all those green candlesticks and everything's trending up. The moving average is going up too, because remember that period is looking backward at prices. They're going up, so the moving average is going up. We then hit this patch where prices are starting to come down, so our moving average is going to start to flatten out, and eventually it's going to go downward. As you can see, it goes downward, and then it's going to kind of continue that downward type of trend with little peaks and valleys there, but it's smoothing everything out. And that's one of the benefits of a moving average. It smooths everything out so you can kind of see a little bit better versus than all this scattered type of information. Now, if we look at the first blue box there here on the left, right at the top of where the green is, you can see this is the first point where you're now starting to see prices, the candlestick, opening and closing, starting to cross the line. And it's going between the line, up and down, all between the line. It's really kind of steady there for that, that 7-day period we were looking at. Why? Because the market is in flux. The market is trying to decide, are we going to go to higher prices, or are we too high and we need to pull back and go to lower prices? You might have heard the term bulls and bears. The bulls would think the prices go higher, the bears would think the prices go lower. We're in a trading range here where people are, these individuals are deciding, and you have enough bulls and bears, enough people trading, selling and buying, that you have people who are now looking at this moving average, and we're now crossing the moving average line. At the end of the blue box, what happens? Well, it looks like the bears won out. Prices go down. You can see they've gone down below the moving average line, and they stay below the moving average line and stay significantly along the moving average line, below the moving average line. And because it's a moving average, the line now starts bending and moving to the bottom too. It's not a straight line, it's a moving line. And thus that's moving with it as prices go down. And you think about it, as they go far enough down, people say, yeah, I should buy the market, it's pretty low, and it'll start to go back up. And we might start seeing that at the bottom where it hits the big volume areas and really hits rock bottom and now starts coming back up. And we've now entered into the second yellow or second blue box there, where we see prices going above and below the line. And now this is a period where we'd want to watch again and start seeing where the trend might emerge. And as it emerges, is the trend going to go down like it did previously, or is it going to go up? And that's where the moving average can help you as far as what might be going on, because we're looking at now pricing averages over a period of time in active markets. Once again, a weighted moving average would assign more weight to this recent downtrend than, let's say, a simple moving average with just putting more weight towards the overall, or doesn't put weight anywhere, it has it over the overall trend. So it's taking advantage of that first 30 days ago, that first big green rise. Let's look at this here. If you see, I draw just some simple trend lines here. Remember that point where we're wondering what might be happening with the market after we hit that peak? Well, if we overload those trend lines in the trend channel, you can kind of see, now that we've got more information, this might tell me that we've got a simple moving average. We've crossed below the average. We've peaked up a bit above it, but now we're crossed below it again with our very last data point there. And our trend lines tend to be trending down. If I was a technical analysis trader at this point, I might say to myself, I might need to see a couple more data points to see if this trend is going to continue this downward trend and then act accordingly, or not act at all. Or do I think we're about to go above the moving average line and our trend might be reversing, waiting for that trend to happen, and then getting in that trend and riding that trend out? So we're really at, if I'm looking at this chart at the far right, I think we're at a real decision-making point of what might be happening next. And that's where moving averages and trend lines can really help you out. Now we're going to look at, the next lessons, we're going to look at some shapes and geometric shapes to help explain this maybe a little bit more and looking for opportunities. Okay, we saw from our pricing charts and our candlestick charts, we can get some good information out there. And we're also seeing, as we overlay trend lines and maybe looking at moving averages, either simple or weighted ones, we can get a little bit more information and starts to maybe tell us a story of what might be happening, at least from a technical analysis standpoint. Now we're going to look at patterns. And now that we've got the story starting to evolve, now we want to really have the story really tell us even more so we can make some decisions on what to do next. Buy, sell, hold, whatever it might be. And the first one we're going to look at is a common one called a rectangle, because it looks like a rectangle. We'll see the chart here in just a second. And really a rectangle is a trading range that is bounded by a support line at the bottom and a resistance line at the top, and the trading occurs between them. A resistance line at the top, support line at the bottom. Understanding support lines and resistance lines are real important. So once again, support line is the bottom, resistance line is the top. Think about it like it's resisting the price going above it is the resistance line. Support line is like supports it from bouncing, going too low. Until there's a breakout, inside the triangle, the prices are trading in there, and a breakout will occur, pushing through either a support line or a resistance line. One thing with breakouts in general, a general technical analysis part is breakouts, when they happen, when they break the pattern, they will tend to follow the original or previous trend, but not always. That's the thing. It's like predicting the weather. It doesn't always happen, but that's the idea, is they will tend to follow the trend, the previous trend that's happening. We just are in a pattern right now. So here's an example of some pricing here. You can see pricing over time. It looks like it's gone up here. The pricing's gone up. And now we've reached a period where we're in a rectangle. You kind of see where the red lines are drawn there, how it looks like a rectangle, right? Prices go to a top, and then they come down to a bottom. But then they go back up to a top, and then a bottom, and then a top, and then a bottom again, and then up to a top again. And they're trading within this range, in this particular range, with the resistance line at the top, as we're talking about, and the support line at the bottom. In this particular chart, as we see here, this particular cryptocurrency we might be looking at, it just can't break through that resistance line. It just gets up that high in price and stops and then comes back down. By the same token, when it gets to the support line at the bottom, it doesn't go any lower either. It gets stuck there, it gets stopped, and it basically gets supported and then goes rebounding back up. And it trades within this pattern. Now, it doesn't always look like this. It might be a little bit narrower or a little bit wider, but when you start seeing this pattern where they're up and down, up and down, up and down over a period, you're in a rectangle. So the key in a rectangle is at some point you'll have a breakout. Something will change, some type of resistance, something will happen where people start investing or something changes and they'll break through either the resistance level or the support line in this particular case. So if we look at this, if you look at the far right, you can see where it's reached the top of this resistance level. Where do you think the price is going to go next? If you were to guess, and this would be a guess, if you were to guess, which way do you think it would go next? Would it break through the resistance level? What do you think will happen next? And the key thing, let's take a look. The key thing is, at this point, we don't know. In a triangle, in a rectangle, we don't know yet. It could either break through, have a breakout, and go up in A and now follow that previous pattern and keep rising. Or it could be like B and go back again in the pattern and go to the support level and then bounce back up again. When you reach the tops and the bottoms, that's where it's either going to rebound and stay within the rectangle or it's going to push through either resistance or the support line. Think about like the sheep on the hill again, where we show the sheep going down the hill. This is like the sheep are caught in the rectangle. And at some point the sheep are going to break through the resistance line and say, let's go, hey everybody, let's go on this hill where all this green grass is. Or they're going to say, no, we should just keep going down that hill and follow the road. And then rebounding back down to which would be B. So when we talk about trends, you want to let the trend establish. Because if we were to guess, like I asked you in the question, where do you think the price will go next? A technical analysis person would say, I don't know where it's going to go next. I need the trend to develop first, and then I'll decide. And if it started to go down, I'd say, it's still in the rectangle towards B. But if it started to break through and go up past that resistance line, I'd say, we've broken through. The pattern is broken, so we've broken out of the rectangle, and now we're on a new trend. And this is where we might want to invest because now the trend is established, we've broken through the rectangle, and we're moving up, is the idea. But until the trend is established, you don't really know. Then you're more guessing whether you're still in the still in the rectangle, or if you're breaking through the rectangle. But when you see patterns like this is a rectangle pattern where it's up and down and it's bounded by a resistance level and a support line. So if you like rectangles, you'll love triangles. It's because it's a converging of support and those resistance lines, either rising or declining. It could be, the triangle could go either way, and we'll look at some examples of that. But the trending range pricing is narrowing and it'll look like a triangle. And once again, the breakout will usually occur in the direction of the original trend. Not always, but that's the idea, is it will tend to occur whichever way it breaks out, or when it does break out, it will tend to break out in the direction of the original trend. So be watching for that pattern when you're looking at triangles. But let's look at triangles now when we're looking and evaluating charts and pricing. So we remember from the rectangle lesson how we had two parallel lines, the resistance line and the support line. In this particular example, we have an ascending triangle. It looks like a triangle with a wider to a narrowing point. And this one is called an ascending triangle because it's going up in pricing. It's a continuation triangle where it's going up in pricing. You see how the resistance line at the top is parallel and is stable, and pricing, when prices rise to that, they hit there and they come back down. But as you see, the support line, instead of also being parallel, it's more at an angle, so prices don't come down all the way. They come down, but then they bounce back up. They hit the resistance line and they come down again, but not all the way to the previous level. They come down just a little bit and then they bounce back up. And you keep getting that going up all the way, down a little, going up all the way, down a little less, going up all the way and down a little less than that until it forms like a triangle, is what the pattern that you're seeing here. And really what in this example where there's ascending or rising prices, what this is saying is people want to buy, they just can't get through that resistance line. It's just too high, but they're not going down below the support line. In fact, the support line is starting to rise in conjunction where people are showing more confidence in this particular, let's say, this particular cryptocurrency investment as an example. So you can see the resistance line is steady and then the support line is rising up to this narrower point. So what should happen at some point here, if the pattern continues, at some point it's going to the support line is going to get so narrow that it's going to just naturally kind of burst forth and burst through that resistance line is what we're looking for here. Establish the new trend and continue that existing trend, which if you saw on the far left, the trend was rising with a little dip, but otherwise it was rising before we got into the triangle, and it would continue that rising trend in the triangle. You can see as a rising triangle as well. One thing, if you're looking at this too, if you're able to get in and see a little bit more of a buying opportunity, if you see the triangle starting to form, you once again want to have enough data, but here's the example where if you can see it where it's starting to form, if you can get in towards the bottom there, you can actually ride the triangle out a little bit more and then see if the breakout occurs, so you get a little extra kind of bump there in the beginning if you start seeing the triangle starting to form. Once again, there's no guarantees on anything with technical analysis. It could completely go through that support line and go down, or there could be some kind of thing that happens, a world event that just messes everything up. But in normal trading patterns, this is a triangle and ascending triangle. Now you can also have descending triangles where you don't want to buy, or you might want to sell your holdings, or it depends on where you're at in the triangle and what your pricing that you paid for something. But the idea is pricing is starting on the decline. Our support line is steady. You know, it's steady. It's going down to the support line, but the resistance line is going down. It's eroding. It's getting closer to that support line. Prices are falling. You can see how the prices are falling over time from the top left to the bottom right, and you can see everything's moving down to a lower period. It might get to a point where it like follow, you know, an existing pattern or something where it might break through and follow that previous type pattern, which in this case I didn't draw it as well on the left-hand side, where it might break through the support line. But the idea of a descending triangle is you're once again going on the descent part of it and break through the triangle. So triangles are very, very common and very used. I don't want to say common, I'm saying commonly used by technical analysis folks, because triangles are pretty easy to understand, and you can start seeing the patterns form, and you can start and it makes sense because of how people are buying and selling. But remember, nothing's foolproof, but if you start seeing triangles, you'll start looking for those triangles and see if they're heading in the direction that you want them to head to. So some chart patterns look like flags, and like a pennant basically on a flagpole, because it's similar to a triangle with a well-established pole, which is your volume. And flags are really based around sharp rises or falls. So the examples of triangles, we were kind of showing this either up or down, kind of, you know, regular type progression. Flagpole or flags are either up or down very, very sharply. And you'll see along the pole part here that there's lots of trading volume. That's part of what makes it a flagpole, is something's happening and there's a lot of volume along the pole, and then it's either going up or it's going down very sharply. So let's take a look at the chart to help this make more sense to you when we're looking at flags. All right, so here's our 30-day price chart. You can see how the lines are going up and down here. And we're looking for a flag in this particular one. This is real life stuff, and I think I saw a flag here, maybe actually two flags, but I certainly saw one flag in here. And do you see it? What you'd be looking for is things where there's a lot of volume. So where there's at the bottom there, where there's a lot of trading, the bars are up high, and there's a big spike in price, either up or down. I'm going to say a little bit more around that. Let's keep it simple and say I'm looking for an upward trending flag, just to keep it simple here for us. A lot of volume, and where there's a sharp rise in prices for an upward type flag. Do you see it? All right, let's take a look. How about right here? All right, so you see, this is where you could say there's a flag that's established or whatever. You could even say there's a downward flag at the beginning of the red volume. But certainly I think where you see some big spikes in volume and a big spike upward where there's a flag. And you can see how it's like a flag that's really breezing in the wind, not that's really going up or down. It's not like a triangle where it's kind of gradual, although it can be a triangular shape like a pennant, but it's really going significantly, very quickly up or down as far as how it would work or how it would look. So if we see this pattern, let's say as a flag, we might know that we're in a high volume trading. That's the flagpole. You see where the flagpole is there on the left-hand side, where we got the pole and you got the flag, and things are pointing up that way. Now, this might be a short-term occurrence, because if we look at our overall trend, and let's add a trend line here, when a flag is over, it tends to go back to the previous trend, is a key part of technical analysis. So if we look at our line, our overall trend was down, and we had this overall downtrend, but then we had this upward trend flag, this upward flag, because we had some people basically buying at such low prices that they wanted to really push that up back again real quickly. but our overall trend is still a downwards facing trend. So if I was an active trader, I might like try to trade right before or in this flag, but then I might want to get out as I'm facing an overall downward trend. So something to consider there. But here's what a flag would look like, and the key characteristics, it's rising sharply or falling sharply. And the other key part is there's a lot of volume associated with it. You could look at other parts of this chart and may or maybe not see flags, but in this one you can see where the volume really stands out, and that's what makes it a flag, because a lot of action is happening and it's driving up quickly. And once again, in this case, we look at the trend as our friend. We can say the trend is like, okay, I'm in a flag, maybe some short-term profit taking, buy, let it rise rapidly, and then sell, because overall, in this particular example, the trend is downward. A famous chart pattern is what's called head and shoulders, because it looks like a head with two shoulders. It's a head and shoulders. And really, you're looking at this head and shoulders with these resistance and support breaks or lines that are part of that. And it's part of an overall trend, and where the trend will head once it gets through this head and shoulders period, it might be a period of change. So let's take a look at an actual chart with head and shoulders and be looking for this type of pattern in your investments. Okay, so first off, do you see the head and shoulders? Maybe you do, maybe you don't. That's okay if you don't. It's not readily apparent, by the way, but you might see a head and some shoulders. Let me overlay this a little bit here. How about now? This is the idea of a head and shoulder pattern, where you have a head or a peak, and then you have two shoulders that, sub-peaks in effect that are part of that. So what's going on here is, in this case, where our prices are rising, we've risen up to a shoulder. We don't know it when we're up to that first shoulder that this is happening, by the way. We just see sharply rising prices. Then the prices fall to this resistance line, or excuse me, to the support line. Also can be termed in the head and shoulder chart as a neckline, like that's your neck, I guess, if you're looking at a person. But that's when the net, so that's the support line, is prices have fallen to that support line, but they haven't gone past that support line. They've rebounded off that support line and gone up higher past the shoulder, past the left shoulder, up even higher to the head, to its next peak. And you'll have certainly trading amongst there won't be in this smooth line like this, might be up and down, but the overall trend is what you'll see when you draw your trend lines, is you're heading to this head. And we reach our peak, and then what? Now we go back down again to our other shoulder, right? So we're going back down, but we don't break through the support line again. It bounces back up to that right shoulder. Now we're on our right shoulder, and then it hits the shoulder and then comes back down to the support line. The key with this is the shoulders will be about the same. If it doesn't rebound to that shoulder, you're not in a head and shoulder situation. And if it goes past the shoulder, you're not in a head and shoulder situation. Because what's happening is that these different peaks, people are buying and selling. At the head, it's reached a real peak and people are like, I got to get out. This is about as high as it's going to get. And at the shoulders, it's almost forming like a new support line at the shoulders for a short instant before it goes down to the actual support line, which is the neckline. So as you see the pattern develop, you can kind of see what's happening. And so if I go up the first shoulder, I don't know what's happening, goes down, and then goes up to that head, and then comes back down and he reaches that support line and starts heading back up to that shoulder, that right shoulder. I might look at that period as a period of opportunity, saying, I might be in a head and shoulder activity or head and shoulder period here. Maybe I'm headed up towards the right shoulder. Maybe I want to invest until I get to that next peak of where the two shoulders equal each other roughly, and then sell at that point as it comes back down in the head and shoulder pattern. Once the neckline is broken, by the way, then the pattern is completed. That's when then you're on new patterns, you're on new trends. You might be in a rectangle. All things could happen at that point. But in a classic head and shoulder picture, this is what happens as far as a shoulder, a head, and a shoulder. All right, so this is one way to look at it. You can also look at it inverted, right? We're like upside down, right? Do this one because it's easier. You see the head, you see the shoulder. Now let's look at this same pattern. This is also head and shoulder. It's just inverted. And you can see where prices are declining here, right? And this might be something that might be more interest, because at the end you might be looking at rising prices. Here you can see a period of falling prices, falling to the first shoulder, in this case the left shoulder, rebounds back up to the resistance line. This is the higher price point, where it's like, no, I don't want to, and people don't want to buy higher, and that's what pushes it back down to the head, where it drives prices even lower to a point where, like, boy, this is so low, I got to go back in and buy. Once again, this is the market. Think of overall, lots and lots of people in the overall market. Bounces back up to resistance line, forms another shoulder. Once again, shoulders are the same, roughly the same height or decrease below. they're the same level, maybe is a better way to put it, and then back up to the resistance line, forming an inverted head and shoulder. Now it could repeat itself in a head and shoulder period, but once it breaks that neckline, in this case the pricing resistance level, then the pattern is completed. And you might have a breakout, right? You might have a breakout where it's broken the neckline and it starts to rise, and you say, oh, I've broken the neckline, I've done my two shoulders, because things happen where people go to a peak and then get out, they go to a deeper peak, the head and get out, and then they go to a peak again, and then overall it breaks out is the idea. So in this case, when I come up to that neckline, I'm going to be watching. I don't want to be investing now, I'm going to be watching and see if it breaks that neckline. And once it breaks through that neckline a little bit, I might say to myself, oh, the pattern is done. We have a breakout. Let me start riding this breakout in this rising case now, because we might be rising past there once that pattern is completed. And you can see from the head to the right shoulder, we're in a period where we're generally on an upward trend. And when the pattern is done, the breakout might tend to go follow that same breakout pattern. Certainly once it breaks the neckline, that's the idea, is it should, or not should, but hopefully will follow that breakout pattern. So with head and shoulders, that's the idea you're looking for, is our heads and shoulders forming, what's happening at the neckline, and then taking action after, if you're starting to see a trend establish itself at that point. But it's a very, very common, very much covered head and shoulders, repeatable chart pattern, which with technical analysis and patterns, that's the idea. We want to see those repeatable patterns so we can then take action. A real good chart pattern is what's called a cup with a handle. And the reason I say it's really good, or one thing I like about it, I guess, is it's combining different types of items. It's combining pricing patterns and trend lines and volume levels and moving averages kind of together into one chart, and you're looking for this pattern. And the pattern looks like a cup. And so let's take a look at that and why this makes sense, and walk through the idea of why it forms a cup and how we can take advantage of it as investors and as traders. Okay, so here's our cup with a handle here. So bear with me a second, there's a lot going on here. So let's walk through it here slowly so you can kind of see all these different moving parts here, because it combines several different things in one chart. So if we first look at the line chart, you can see that in this particular example, there was a steady rise here in pricing going left to the right. And then there was a kind of this indentation, which was kind of the cup part, and where prices reached a peak, they fell, they stayed low for a period, and then they rose back up again to another peak, and then they leveled off, and then they rose again. So you see our line where we go up to a peak, we bottom out, stay bottom, rise back up, flatten out, and then go back up to a rising pattern. So you can see the cup and the handle here on our chart. I put some little extra things in there to make it easier to see. You can see where it looks like a cup, right? The inside where you put your liquid, and then there's a handle at the top here, and you want the handle to not be downward facing. You want it to be, parallel, or maybe a little bit more, upward facing as far as this rising trend type pattern. And the thing with any of these types of charts, you're not going to see something that's going to look exactly like this. And this is pretty clean looking as far as a definite showing cup and handle. You might have to kind of, interpret a little bit more when you're looking at an actual chart. But what's going on here is prices have risen. You can see my yellow simple moving average, right? Remember our moving average lesson? If you haven't looked at that, do look at that again. But you can see how my prices are above the moving average at the start here, and that's a good thing. And so that's good. It stayed above the moving average. I then leveled off and came back down to it peaked and then came back down to my moving average, where we have a period where the pricing is going above and below the moving average as the market sorts itself out. It rises back up again to the right-hand side peak of the cup, where the market has decided we're going to go move forward. Some people get scared and sell out, so it flattens out at the handle, and then it goes back to that rising pattern again. So that's the kind of the thought process behind it. Is it's rising, people get a little scared or say, no, I need to take profits or sell, forms a cup, gets back up, levels out again to kind of shake the last people out who weren't so sure, didn't sell the first time, and then goes on the rising pattern. And we're overlaying our simple moving average to see how that forms at the bottom of the cup. And then everything you can see in this example is still, on the left and the right hand side are above the moving average. The other part that's very important on the cup and handle is trading volume. You can see where we have our normal trading volume on the left hand side when prices are rising. And then when we form the cup, what you want to see is lower trading volume. Basically people kind of shaking out of the market, but not everybody, or not a lot of people, because then you would really have a downward trend. Really all you have is a period where people are shaking out of the market, and you have this low volume trading. And then the volume trades up higher as people like get in and say, boy, this might be a buying opportunity because the prices have come off their peak. And that's where the handle forms. And then after the handle, we're back to a rising pattern. So it's an interesting pattern. What I really like, because it's overlaying a lot of different stuff. And once again, I want to know like exactly, but I've got rising prices. I've got a falling low volume period where it's shaking out some prices, followed by a rising period. Then it shakes out the last people on the handle who want to sell off at that peak, what they perceive as the peak, and we're back to a rising pattern. So you can see you want to buy, probably towards that handle, or certainly at the end of the handle when it breaks out of the pattern at the handle and starts forming into and now a rising pattern. If it was to go back down again, then there's something else maybe going on. It's not a true cup and handle, because you need to let that pattern emerge, to establish the new pattern. But once it does that can, typically this is what it'll be, but you're overlaying all these pieces, your prices in line, looking for the cup and handle, looking at your moving averages, and then looking at trading volume. And if there's something extraordinary doesn't happen, this is the idea of how the pattern will typically follow. Some final thoughts on technical analysis. And really with it is, it's another tool in your toolbox. I would say it's okay to use with fundamentals too. I think why not have more information, at least a certain amount of information. If I think of something and I understand the fundamentals, and I layer on technical analysis to make trades at the appropriate times, especially in a really volatile market, use them together might be a good strategy. Though once again, a true technical analysis person would say, forget that fundamental stuff, just look at the chart. I like to use a little bit of both. Also, what's important is use what you're comfortable with, right? I've given you some examples here. There's other things you can go through. You can read entire books and things on technical analysis, but use what you're comfortable with and makes sense to you. If the cup and handle just seem just a little too much, a little complex, but just simple trend lines work for you, great. Use what works for you. And the idea is none of this is foolproof in any way. If it was, we wouldn't have courses. We would all be super wealthy because we would all follow the same charts, and follow the same pattern. So it's certainly not foolproof. Nothing is perfect. It's like, once again, I think predicting the weather, you can do it most of the time, but it's not perfect. Same thing with predicting the rising and falling of currencies. There's no perfect method to it, just tools that we can use to give us a better chance to be successful, and that's the idea. And technical analysis can really help you with that. And one thing with technical analysis too, I've showed you some of the most common ones, some of the most widely known, used all the time, very effective ones. There are thousands and thousands of different ways you could interpret charts. There's all sorts of other, head and shoulders plus, or different types of patterns out there. So you might be watching this thing, well, what about this type of pattern? You didn't talk about this pattern. That's because there's thousands out there, and you can take a whole, courses on technical analysis. And if you love technical analysis from this part that we've talked about, take another course on technical analysis, get really super deep in it. That's good, go for it. But I want to give everybody the tools to be successful, at least to get started with it. Other thing also is understand that overanalysis may lead to paralysis, right? Paralysis by analysis is a term out there in the business world, which leads you to do nothing. Because sometimes you can overanalyze something and do 80 different charts on the same thing and come up with like, these 60 charts say I should buy, and these tell me I shouldn't, and I don't know what to do, and I do nothing. So don't overanalyze is my recommendation. Use what you're comfortable with, use your fundamentals, use your technical analysis, use what you're comfortable with, and use your gut and all that stuff. And if you overanalyze and you find yourself not doing anything, it's probably because you're overanalyzing. Michael Kahn, who wrote some book on technical analysis, had a great quote where he says, too much analysis may assign meaning where there is none. So where you can have analysis leading to paralysis. Sometimes what happens if you do too much analysis, you might actually start seeing things that really aren't there because you just overanalyzed it too much and did too much analysis, and you're assigning meaning to something that really isn't there. Where with less analysis, actually might show the patterns start to emerge in more a true way versus something where I'm just kind of overanalyzing it, and now I might be seeing something that's not there. It's in effect like a mirage, in the desert. Final thought with the technical analysis, you can probably get us what is. What's your friend? If we're talking about technical analysis, what's your friend? That's right. The trend is your friend. And so follow those trends, but the key part of it is wait for the trend to develop. Where people get messed up with technical analysis, they haven't let the trend develop. They think, oh, I think it's developing, but it really hasn't. They jump in too soon, and then they're disappointed. Let the trend develop, not all the way, because you don't want to be at the end of your trend, but of course, but let it develop, and then go in with confidence. And be willing to change your mind too. I mean, this is why they call it trading. You're buying, you're selling. Things happen, things change, right? But the trend is your friend, wait for it to develop, and ride those trends to success. And if you love technical analysis, that's what it's all about. And I'm really wishing you success around whether your analysis is around fundamentals or technical analysis. Either way, that you're making great choices for your investments.